Morning everyone, welcome to today's presentation. So as Joanna said, I'll be talking about superannuation and really just trying to do an update on superannuation and talk through a lot of the changes that we've seen recently in what the government's done. So first up, just a disclaimer, as with all our presentations, they're just general advice, so you really need specific advice if you're going to go further with anything. In terms of what I want to cover today, just briefly, just as a starting point, there's been a lot of changes to superannuation, and every year the government seems to make more changes. So a lot of what I want to do today is talk about the changes that have occurred. So there's been changes to the contribution rules and caps, what we can put into superannuation, whether it's a taxable contribution, whether it's a tax-free contribution. We've seen changes in the amounts that we can have in pension mode. It used to be 1.6 million, now it's gone to 1.7 million. We've had big changes to whether people can make contributions based on their age, so I'll talk through those, and that's really focusing on people between the age bracket of 67 to 74 and what they can and can't do. We've got some rules for people that have relatively low superannuation balances and be able to bring forward unused contribution amounts. We can also split contributions between spouses, so I'll talk about that. Talk about downsizer contributions, so you can sell your principal house and put more money into superannuation. Talk about benefit planning, pensions, and also finish with talking about superannuation funds and property. The first slide I'll go through, my key points are that from 2021 all the way through to 22-23, the government's continued to make changes to superannuation. So that's really my key point for this slide, is that if you're going to do anything with superannuation, you've got to understand what the rules are for the current year. And a couple of key observations. We used to be able to only make taxable contributions of $25,000 a year back in 2021. In the 21-22 year, it increased to $27,500, and that's the same amount for the 22-23 year. So be aware of what the contribution caps are. Very similar with tax-free contributions. Back in 2021, it was $100,000 per year, or if you could do the 3 times that cap, it was $300,000. In the 21-22 year and the 22-23 year, well, the government's changed that amount from $100,000 to $110,000, so which we can do now $330,000 over 3 years. So again, just being aware of what those caps are. The amount that we can have in pension mode, again, going back in 2021, it was $1.6 million was the most we could have in pension mode. That's gone up to $1.7 million in the 22-23 year. So again, really just the key point of this slide is that every year the government seems to make further changes to superannuation. I find as a professional in superannuation really hard to stay on top of the changes. So if you're going to do anything, what are the rules for the current year, and then apply that logic to what those rules are. So yeah, just be aware of the changes. A lot of the changes that we've seen in superannuation since 1 July 22 have been brought about by changes that the government proposed back in the May 2021 budget. And just going through those changes briefly, the first thing the government did is they brought in a new rule which said that we now don't have to have a work test for those between the age of 67 to 74 to be able to make a tax-free contribution. So that's a big change. Now previously, if say someone was within that age bracket, they would have to meet a work test to be able to make a tax-free contribution. The government's brought in legislation that from 1 July 22, for someone in that age bracket, they don't have to work anymore to be able to make that tax-free contribution. The government also had this rule about to be able to make a downsizer contribution, you had to be over the age of 65. From 1 July 2022, that age has been decreased from 65 to 60. What's also interesting, and again it's just showing the continual change in superannuation, there's legislation before the Parliament at the moment to even bring that downsizer age down even further. So it's going to come to the age of 55, and they're proposing if that legislation gets passed, that'll kick in and start from the 1st of January 2023. It's almost getting close to my age to be able to make a downsizer contribution, but again, the key point is there's just continual change in superannuation. Part of the budgetary changes, one I've already touched on, is the non-concessional rule. We've got the amount, the 3 times $110,000. That can be done for someone between the age of 67 to 74. They don't even have to meet a work test. So previously, you could only do 1 times that cap between that age bracket, but now you can do the 3 times and not even have to meet the work test. So that's a big change. What we're going to expect as a superannuation industry is that we're going to see, as a result of these rules, we're going to see lots of people looking at planning in terms of their superannuation and strategies. And it's going to be a lot about people looking at their superannuation fund and maybe trying to shuffle money from mum to dad or from dad to mum, depending on who's got the higher balances, who's got the lower balances. It's also going to be about if a member has a superannuation account with a high taxable component, So for estate planning purposes, they might be trying to take money out of a fund and then putting it back into their own fund as a tax-free contribution to change the taxable component, create a better estate planning result for when you ultimately pass away, or possibly trying to put money into your spouse's name to increase his or her superannuation. So, as I said, if you're between that age bracket of 67 to 74, there really is some strategies that we can look at to get a better result from an allocation perspective between the two members, or from a tax perspective between the two members. Another change is the superannuation guarantee monthly threshold's been removed. So it was $450, that's been removed on a monthly basis. And also the superannuation guarantee rates continue to increase. For the 22-23 year, we're at a rate of 10.5%. Just touching on the no work test for those aged 67 to 74, as I said, that kicks in from 1 July 2022. So this is a great opportunity for people that are between that age bracket that are not working to still be able to make non-concessional contributions to superannuation if they're below that $1.7 million threshold of superannuation. I'll use a brief example. I've got Florence, who turned 75 in October of this year, so in 4 weeks. She's got a total superannuation balance of $1.4 million. She doesn't work. She hasn't triggered a 3-year rule before. So Florence could go and make a $330,000 tax-free contribution, a non-concessional contribution, prior to her 75th birthday. She wouldn't have been able to do that prior to 1 July 2022 assuming she wasn't working. And even before 1 July 2022, if she was working, she would have only have been 1 times the yearly cap, so she would have only been able to do $110,000. So this is a really big change from the government. And as I said, there's a really great planning opportunity for those between the age of 67 to 74 to look at their superannuation and look at what we can do between spouses if you're below the superannuation cap of $1.7 million and work through what we can or can't do. If you're between the age of 67 to 74, what you've also got to keep in mind is that you can only make taxable contributions. So say for example, you might have some investment income and you might want to make a personal taxable contribution of up to $27,500 per year. If you're between that age bracket and you want to make a taxable contribution rather than a tax-free contribution, you've got to be gainfully employed, and gainfully employed is all about working for 40 hours over a 30-day period, at least once during the year, being paid for working, and then you can still make a taxable contribution. So the change that the government's made, really just trying to stress, is for tax-free contributions, you've still got to work to be able to make a taxable contribution. I've already touched on this, concessional contributions. The cap is $27,500 per year. A concessional contribution is a taxable contribution. Brief example, Max earns $100,000 a year as a salary. His concessional contributions or taxable contributions could be, say, the superannuation guarantee of 10.5%, let's say $10,500. He could do a salary sacrifice contribution to get him up close to that $27,500. But also importantly, he could do a personal taxable contribution to get him up to that full $27,500, and that would be a contribution that he would claim as a deduction in his personal tax return. So again, really just trying to stress that you really have to look at what are the rules, what are the caps for the year, and how can we use those caps to get the best result for each year that we're looking at. Another point that I'll just briefly touch on is one of the changes that the government made. This change went back to 1 July 2019, and that was that people can bring forward unused taxable contributions. So say for example I work and I earn $100,000 a year and I only make, say, taxable contributions of, say, $10,000 a year. I'm obviously not using my full cap. I'm able to carry those forward and use them in a later year, either as an employer contribution or as a member personal taxable contribution. But I can only carry them forward if my total superannuation balance is less than $500,000. So this is really a bonus for people that have a relatively low superannuation balance to be able to carry forward those unused taxable contributions. And also someone might have a year where they make a very large, say, capital gain, they sell a property, an investment property. This might be an opportunity to use those unused taxable contributions in the year that you do have very, very high income. Tax-free contributions, I've touched on this already, but the tax-free contribution cap is $110,000 per year, assuming you're under the age of 75. You can do 3 times that to get it up to $330,000. A tax-free contribution can either be cash going into a fund. It could also be listed shares. You could transfer those into the fund. You'd have a capital gain event there personally, so you'd have to weigh that up. So that's another option if you've got a self-managed superannuation fund to be able to transfer or contribute shares to your superannuation fund. And most importantly, you've got to look at your cap balance. You can only do a tax-free contribution if you've got a superannuation balance of less than $1.7 million. But for the 21-22 year and the 22-23 year, you've got to look at your actual balance to work out whether you can do the full $330,000 amount, and that's going to be determined by whether you've got less than $1.48 million, you can do the full amount, and then there's basically a sliding scale that impacts on what tax-free contributions you can make. So again, another area where the government's continue to make change, quite a complicated area, but you've just got to be aware of what your balance is at the start of the year, and that's going to determine what you're allowed to make as a tax-free contribution. You can make a spouse contribution and get a tax rebate. So that's if you make a contribution up to $3,000 for a spouse, you can get a tax rebate of up to 18% of the contribution, up to a maximum of $540. So that's another tax planning opportunity. Downsizer rules, I've got to be aged over 60 at the moment from 1 July 22, was 65 prior to that age. Government's looking to change it to 55. You've got to own your own house for 10 years. It's got to be after 1 July 2018, so that's when they brought in the legislation. You've got to make the contribution to your superannuation within 90 days of settlement, and you've got to fill in a form. You just give that form to your superannuation fund, doesn't have to go to the ATO. So if you're going to do a downsizer contribution, you've got to complete a form. If you've got a self-managed, you just give it to yourself effectively. If you're part of an industry type fund, you've got to send it into the fund. The fund's got to know how to allocate that contribution, because a downsizer is a special contribution that, for example, allows you to make tax-free contributions after the age of 75. Just had a brief case study. Dad's 72, still working, has 1.7 million in pension mode and 320,000 in accumulation mode. He's got mum who's 70, aged 400k in pension mode as well. Mum's not working. And really the key points that I'll raise, there's probably a number of different areas we could go with this case study, but really, as I was saying before, with the government changes from 1 July 22, people under the age of 75 now can make those tax-free contributions, assuming they're under the superannuation cap amount of $1.7 million. So there is going to be the ability for Dad to maybe take money out of his superannuation or out of his accumulation balance or even out of his pension account and transfer that across to Mum to get a better result overall. So Mum and Dad need to look at their situation, and if they can, possibly shuffle or transfer monies between each other to take advantage of those rules. Benefit planning, just briefly, if you're over the age of 65, you've got full access to your superannuation. You can either take it out as a lump sum or you can start a pension. You can also take superannuation once you're over your preservation age, but really the main point is that if you're 60 or older and you leave an employer, you permanently retire, you've then got access to your superannuation, that's when you can start to receive a pension. And also, most importantly, once you're 60 or older, whatever you take out of superannuation, you receive tax-free. So a lot of our clients, when they do reach 65, they've met that key condition of release. Just about most of our clients, once they get to 65, they would be looking at starting an account-based pension. Again, an area where the government's changed. We used to only be able to have $1.6 million in an account-based pension. Now it's gone up to $1.7 million is the amount that we can start an account-based pension with. So again, an area that the government's changed. And the most important point with a superannuation fund going into pension mode is that the investment income becomes tax-free. Just quickly, the government, again, has changed areas of superannuation. We used to have to pay a minimum percentage based on our age, which was under 65, 4%, over 65 to 74, 5%. Because of COVID, interestingly, the government reduced that minimum pension to 50% of the yearly amount. So 4% became 2% and so on. It's interesting that the government really now for 4 years has allowed that 50% minimum to go on because of the impact of COVID and the impact on the financial market. So for the year that we're in, 2022-23, if we've got a minimum pension calculation, again, we only have to pay 50% of that minimum calculation. Don't know what will happen next year for the 23-24, but yeah, just be aware that we don't have to pay as much as what we would normally do in terms of a minimum pension. Super funds and property. A super fund can invest in property through a self-managed superannuation fund. Can do it in a number of ways, so just keep that in mind. A superannuation fund can buy property, whether it's directly, whether it's through a unit trust, whether it's through a borrowing arrangement, through what's called a limited recourse borrowing arrangement. So superannuation funds can invest in property. You've just got to follow the rules and the regulations. You can borrow, as I said, that's referred to as a limited recourse borrowing arrangement to purchase property. Rules are quite complicated. You do pay a higher interest rate, but there is a way of being able to borrow to purchase a property through a superannuation fund. What should people be focusing on? Maximise concessional contributions. So if you can make a taxable contribution and that's going to save you money, look at doing it. Tax-free contributions, look at those rules, look at the strategies around what you should be doing. As I said, people will be looking to take money out of superannuation in certain situations and putting it back in, either from a process of trying to allocate it between spouses or to try and change the allocation of their taxable, tax-free amount that's in superannuation. Each person's allowed up to $1.7 million in pension mode, so that's $3.4 million over 2 spouses, so very concessional from that perspective in terms of what we're allowed as a couple to have in superannuation. So try and take advantage of that if you can. If you're in pension mode, as I said, you've got those key tax advantages. Franking credits are still very valuable. At the moment, the government still gives every dollar of franking credits back to a self-managed superannuation fund or to an individual. So franking credits, listed shares are still very attractive just from a tax perspective. Estate planning, we touched on that in the earlier session, but be aware of the estate planning considerations. If you're running a pension, is it going to be a reversionary pension? Is it going to be a non-reversionary pension? Who is our superannuation going to be paid to on our death? Keeping in mind, again, going back to the strategies, if superannuation goes to an adult child, the taxable component basically gets taxed at 15%. So have we looked at our superannuation? Have we been able to set it up in the best way to avoid any tax, assuming a spouse is no longer around to pay it to, and it's going to get paid to an adult child who's not dependent on you? And keep in mind that property is still a way that superannuation funds can invest in through a self-managed superannuation fund.